What's going on? In this video, I'm going to show you 10 rules of successful real estate investment. And these rules are going to be very specific that I will advise you if you want to invest in real estate, you go by them. And once you go by them, you're going to make it real time. I have researched and bring up the following rules of successful real estate investment. So one of the rules is that when you want to invest in real estate, number one rule is you have to educate yourself. You know, knowledge is the new currency. Without it, you are doomed to follow other people's advice without knowing if it is good or bad. So if you do various research on a business that you want to start, it is going to be a guideline for you or a right path that will help you to follow. It will help you take you from being a good investor to becoming a great investor. And that knowledge will help you provide a passive stream of income for you and your family. Number two rules that you have to follow when investing in real estate is you have to set investment goals. A goal is different from a wish. You may wish to be rich, but that doesn't mean ever taking steps to make your wish come true. Setting clear and specific investment goals become your roadmap and action plan to become financially independent. You are statistically far from likely to achieve your financial independence by writing down specific and detailed goals than not doing anything at all. Your goal can include the number of properties you need to acquire each year, the annual cash flow that you want to generate, the type of property, and the location where you want to kind of invest in any of your real estate. You may also want to set parameters on the rates of returns you require for every investment. This rule is key in whatever investment you want to do. Rule number 3, never speculate. Always invest with a long-term perspective in mind. You have to look at the future. Never speculate on quick short-term gains in appreciation. If that is the type of thing you want to do, then you're going to kind of have it wrong. Even in a heated market, experiencing double-digit gains is mostly difficult. You never know when a market will peak, and it is usually 6 to 9 months or 10 months or 12 months or 1 year as the case may be, after you've already found the fact in that type of business. 4 rules is that you invest for cash flow. You know, cash flow is very important in your day-to-day life. When few are exceptions, always buy investment property with a positive cash flow. The higher the better. Your cash flow on cash return is directly related to that of the before tax cash flow from your property. So cash flow, like I said, is good in whatever investment or whatever life you want to live in. Cash flow is the glue that keeps your investments together. Your equity will grow over time through appreciations and loan amortization, while the cash flow covers the operating expenses and debt services on your property. Rule number 5 is that the market agnostic. You have to be always kind of ready for what is happening in the market. Alright? If you don't know the exact market, how the market is moving, then what are you doing in that market? Each market moves up and down independently of one another due to many local factors, and those factors are what you have to study when you want to invest in real estate. As such, you should recognize that there are times when it makes sense to invest in a particular market and times when it doesn't require it. That is something you have to always know, and if you know what that's required, then it is good. Only invest in markets when it makes sense to do so. Not because you live there or you bought property there before, that will prompt you to invest in that type of markets. There are elements of timing and you don't want to buck the trend. So you have to know that. Bear that in mind. Rule number 6, take a top-down approach. You have to what? Take a top-down approach. Always start by selecting the best real estate market that align with your investment goals. Most investors start by analyzing properties with little to no regards of its location. But you know, I've already told you in my previous video that location is very important in real estate investments. This can be a big mistake if you don't consider the investments in light of the market and the neighborhood it is. You don't expect to have a property in Mashaka and then you want that property to provide you an income like the one at Ecowa Street. The best approach is to first choose your city or town based on the health of each housing market and the local economy. From there, you will narrow things down to the best neighborhood. If you have to invest in real estate around the Western Rural District, then you have to realize that there's no way you have to compare the income generated from investment in the rural area than that of the western urban. Finally, what you should do is you will look for the best deal within those neighborhoods. So if I'm here and I want to invest in the western rural, then I have to look at it critically. 7 is you diversify across markets. You have to focus on one and then you try to accumulate 5 income property per market. Once you have added these 3 to 5 property to your portfolio, you would diversify into another prudent market that is geographically different than the previous one. Hopefully you getting all the rules. Typically that means focusing on another state. If you have invested in western rural, then there is that likelihood for you to move to the western urban area. One of the underlying reasons for diversifying within the same asset class, that is real estate, is to have your assets spread across different economic centers. So if there's a fall in one area, you're going to recover from another area. Every real estate market is local, and each housing market moves independently from one another. Diversifying across multiple states or multiple cities helps you reduce the risk should one market decline for another. Let's say probably an increase in unemployment. If unemployment is at a decrease in a certain area, then where there is an increase, there's that likelihood if you have invested in that area, you will make an income from there. Even if you don't live in an area, let's say I don't live in Bo, there is an increase in employment in Bo and I have real estate there, I'm going to make it big time. That is why you have to diversify your investment. You don't need to invest just because Lumley Beach is a beach area and you put all your investments in that area. What about if people want to invest in the western area? Let's say when there was this forecast of having an airport at Mamama. If you would have got a real estate at that point, then imagine how that would happen. So diversifying your investment is key. Number 8 finally is you use professional property management. Never manage your own properties unless you run your own property management company. If you want to run a real estate company and then you want to manage it as well, it is going to be difficult. Property management is a thankless job that requires a solid understanding of tenant, landlord laws and good marketing skills, and also strong people skills to deal with tenants' complaints and excuses. Your time is valuable and should be spent on your family, your careers, and looking for more property is also there. So if you want to kind of invest in this form of stuff, the rule is saying that you have to hire a property management to control that of the business. And 9 is you maintain control. Be a direct investor in real estate. Never own real estate through funds or partnership or other paper-based investment where you own shares or other securities of an entity. You always want to be in control of your real estate investments. Don't leave it up to corporations or fund manager. This type of business involves your daily cash flow. So if you want to get money out of it directly, you don't need to leave it. 10 is you leverage your investment capital. You see, real estate is the only investment around the world where you can borrow other people's money to purchase and control income producing properties. This allows you to leverage your investment capital into a more property than purchasing using all cash. That leverage magnifies your overall rate of returns and accelerates your wealth creations. As long as you have a positive cash flow and your tenants are paying off your mortgage by rent or your loans, which most probably you must have gone into when trying to get your property, it will be foolish not to borrow as much as possible to buy more property. You remember I told you in that video. So if this video is worth it, please hit that like button. I want to say thank you.